Good morning, everyone. I'm Michele Carroll, and welcome to the News Diet. Today, I'm going to talk about the recent inflation report and the subsequent response by Wall Street. Let's be informed so we can get on with our day. Before we jump in, I just have to ask that if you enjoy the show, to please hit that subscribe button. We all know that YouTube pays more attention to channels with engagement from their viewers, so as a new show, it would make a huge difference and seriously means so much. Getting the word out there that there's a healthier alternative to staying informed is a big goal right now, so if you're looking for ways to support the show, subscribe and be sure to turn on notifications. The Labor Department came out yesterday with the August inflation report that showed higher than expected results, meaning that inflation continued to go up despite efforts from the Biden administration and the Federal Reserve to cool the economy. The August Consumer Price Index report showed an increase of 8.3% from last August, which is higher than the projected 8.1%. Or another way of looking at it is increasing from 5.9% in July to 6.3% in August. We've been experiencing rampant inflation for much of this year, with the biggest year-over-year price increases in over 40 years. At its peak in June, the Consumer Price Index had gone up by 9.1%. Since the same month in 2021, which sparked responses from both the Federal Reserve and the White House, where the Fed continued raising interest rates in an attempt to slow borrowing and consumer spending, and Biden signed into law a massive bill called the Inflation Reduction Act. The IRA, as it's being called, is a $750 billion package that provides funding for climate change initiatives and the IRS, regulations for the healthcare industry, and taxes on big corporations and stock buybacks. This law was very partisan, with every Republican in Congress voting against it, claiming it doesn't do anything to actually fight inflation, and Democrats celebrating it, considering most items fall along Democratic agendas. Between these efforts, economists were hoping that maybe inflation was starting to slow, as some indicators were starting to see prices drop, like gas, which is now at an average of $3.71 a gallon compared to the peak of over $5. However, many other areas continue to see increases, with chicken having risen 17% in the last year. Eggs increased 2.9% from July to August and are up almost 40% over the year. New car prices continued to go up 0.8% in August, which puts that at 11% since August 2021. Also, rental costs increased 6.7% from last year, which is the most since 1986. Some of the reason why inflation continues to be so stubborn has to do with a few things, such as strong job growth, low unemployment, strong pay increases, global supply chain issues, and also the almost $2 trillion stimulus package passed last year. In other words, consumers have more money to spend than suppliers have to sell, and inflation serves as a catch-22 because when prices rise, workers want to make more money to afford the higher cost of living, so business owners need to raise prices to afford the higher wages and higher cost of running their business. And so the cycle continues. The results of this August report shook Wall Street investors and caused stocks to fall yesterday, causing the biggest one-day drop since June 2020, during the height of the pandemic. All three major U.S. indexes were down, with the Dow Jones by 3.9%, the S&P by 4.3%, and NASDAQ by 5.1%. Also, major sectors like communication services, consumer discretionary, and tech fell by more than 5%. The reason investors are so spooked is that many were hoping that August would turn out numbers showing inflation slowing, because if it was, then the Fed would be less likely to increase interest rates again. The Federal Reserve has already increased rates by a full 3% in the last 6 months, which is a lot. And the fact that inflation continues to go up means that they'll likely increase it again, possibly by another full percentage point or basis point. What this means is that the slowdown of the economy is likely going to be more abrupt than economists hoped. In other words, a recession, which everyone was hoping to avoid. Some think we're already in one, with the traditional definition of 2 consecutive quarters with fallen GDP has already been met. but active consumers so far have kept the economy strong, a little too strong. Fed Chair Jerome Powell was trying to ease things slowly, but now is likely to get more aggressive. You've just been informed, so now it's time to get on with your day. I'm Michele Carroll. Thanks so much for listening. If you enjoyed the episode and want to continue following a healthier alternative for staying informed, where I forgo partisan fighting and fear-driven narratives, then please be sure to hit that subscribe button, as of course you'll get more of this show in your feed, and also you'll be helping this new channel grow and reject sensational media. Thank you so much for your support, and I can't wait to see you in the next episode.